Meta is back in the spotlight after raising its 2026 AI spending plan to as much as $145 billion. Investors are asking one question: when will this investment pay off? But after looking closer, I think the market may be missing the bigger picture. For long-term investors, the key question isn't what Meta is spending today, but what those investments could create tomorrow. Hey everyone, I'm Austin and welcome back to the Everyday Investor. There's been a lot of discussion around Meta lately. Some investors believe the company is positioning itself for the next phase of the AI race. Others worry that this could turn into another expensive capital spending cycle. So today, I want to take a closer look at what Wall Street is really afraid of, and whether those fears reflect actual risk or a potential opportunity. To understand why Meta is willing to spend this much money, we first need to understand what Meta's core business really is. When people think about AI, they usually think about chatbots, AI assistants, or large language models. But for Meta, those may not be the most important pieces of the puzzle, because Meta's real money-making machine is its digital advertising ecosystem, built around Facebook, Instagram, WhatsApp, and Threads. Every day, billions of users generate data, engagement, and content interactions that feed this enormous advertising engine. And the biggest value AI brings to Meta isn't creating an entirely new business. It's making the existing business more efficient. Better recommendations, higher ad conversion rates, longer user engagement. Each improvement may seem small on its own, but for one of the largest advertising platforms in the world, even a modest efficiency gain can translate into billions of dollars in value. So in many ways, Meta's AI strategy isn't about building a new business. It's about upgrading the one that already works. I think many investors make the mistake of comparing Meta to other AI companies. But Meta's situation is different. The company already has a proven business model. So for Meta, AI isn't about building a machine from scratch. It's about making an already successful machine even better. Even so, the market remains concerned, and the reason isn't difficult to understand. Investors aren't just worried about AI itself, they're worried about what Meta is becoming. For years, Meta operated as a classic internet platform business. It generated strong margins and massive cash flow through advertising. But as AI infrastructure spending expands, Meta is investing heavily in data centers, servers, and computing capacity. In other words, investors worry that Meta is gradually shifting from a light asset advertising company into a business that requires enormous ongoing capital investment. And that transition brings higher fixed costs, longer payback periods, and greater execution risk. That's why the stock often reacts negatively whenever capital spending expectations move higher. Because what the market fears most isn't spending itself, it's uncertainty around when the returns will show up. Wall Street is usually very good at pricing the next few quarters. But the true value of a business often takes years to become visible. And I think Meta may be experiencing exactly that disconnect between short-term sentiment and long-term value. If data centers determine how much Meta will spend over the next few years, MTIA may determine how much Meta can earn over the next decade. Today, Meta still relies heavily on third-party hardware, especially NVIDIA GPUs. They're incredibly powerful, but they're also incredibly expensive. As AI adoption continues to grow, computing costs are becoming one of the largest expenses across the industry. That's why so many technology companies are developing their own chips. Google has TPU, Amazon has Trainium, Meta has MTIA. And the logic is simple. The future isn't just about building better models, it's about running those models at lower cost. That's why MTIA could be much more than a research project. It has the potential to reshape Meta's cost structure. If more AI inference workloads eventually run on MTIA, the cost of content ranking, ad recommendations, and AI-powered services could decline significantly. and those savings would eventually flow directly into profit margins. And to me, this may be the most overlooked part of the entire story. The market sees higher spending today, but long-term investors should be asking whether those investments can lower costs in the future. If the answer is yes, today's spending could become tomorrow's competitive advantage. Of course, that doesn't mean everything will go perfectly. This is still a massive infrastructure build-out. We're talking about well over $100 billion in investment, and the benefits may take years to appear in the financial statements. The broader economy also matters. If global advertising demand weakens before AI efficiency gains fully materialize, profit margins could come under pressure. There are also risks around chip development, deployment timelines, and execution. So this is not a risk-free story. But in my view, the biggest risks are about timing, not direction. For long-term investors, the hardest part often isn't identifying the trend. It's deciding whether you're willing to wait for that trend to play out. And that may be exactly where Meta stands today. But after considering all of these risks, there's another question worth asking. Has the market already priced them in? Based on today's valuation, the answer may be yes. Compared with many other mega-cap technology companies, Meta's valuation remains surprisingly reasonable. In other words, investors appear to have already discounted many of the concerns surrounding higher spending, margin pressure, and longer payback periods. And that's exactly what makes this situation so interesting. The market is focused on rising costs, lower near-term margins, and delayed returns. But long-term investors may be looking at something very different. If Meta successfully lowers infrastructure costs through MTIA while improving advertising efficiency through AI, today's spending could ultimately lead to much higher profitability. And once capital spending peaks and cost efficiencies begin to emerge, the market's perception of Meta could change dramatically. In that scenario, what investors fear today could eventually become the catalyst that unlocks future value. To me, the real story isn't how much Meta is spending today. It's whether those investments can drive higher efficiency and margins in the future. The market sees costs. Long-term investors may see opportunity. If Meta delivers, today's concerns could become tomorrow's value. What do you think? Let me know below. I'm Austin. Thanks for watching.